Welcome to Iron Financial. This is the place where we forge stronger portfolios by cutting right through the market's weakness. Today, we're putting Tyson Foods on the anvil. You've probably seen the headlines. The stock is hammering out new 52-week highs. And on the surface, that looks fantastic. But headlines don't pay the bills. When you look under the hood of this company, the engine is sputtering and frankly, we're smelling smoke. So our job today is to run a full stress test. We're going to determine if Tyson's structure is a fortress built on solid ground, or if it's a trap, just waiting to spring on unsuspecting investors. We have to know if this thing can actually hold its own weight when the pressure is really on.
And that's really the heart of the issue, isn't it? Everyone sees the ticker symbol, TSN. They see that big, beautiful high. The financial news networks are cheering it on. But what's the real story behind those numbers? Here at Iron Financial, we just don't trade on headlines. We invest based on fundamentals. So the question we have to ask is this: is this a solid, well-constructed investment, a true global leader that you can actually build a position on for the long term? Or is the market just running on pure hype, building a house of cards on a foundation that's about to crumble? I am seeing a major disconnect here that we absolutely have to investigate.
All right, let's get right into the numbers. And to be fair, we always start by building the bull case. You have to understand what the market is seeing, right? What's driving all this optimism? Well, the stock recently punched right through to an intraday 52-week high of $65.96. Now, from a purely technical perspective, this is a picture of undeniable strength. It's a breakout. This is precisely the kind of momentum that gets short-term traders excited. It pulls in fresh capital, and it creates this fear of missing out. You really can't ignore a chart that looks this powerful. No, you can't ignore the chart, but you absolutely must look at the fundamentals behind that chart. And this slide, this captures the central conflict, the entire story in one single frame. On the one hand, you have that powerful market signal, a roaring 52-week high. But on the other hand, you have the financial reality, a catastrophic, jaw-dropping 76% collapse in year-over-year profit. This isn't just a small discrepancy, a rounding error. This is a chasm. This is precisely the kind of disconnect that creates what we call a bull trap. It lures investors in with the promise of easy gains, right before the floor completely gives out from under them. So today, we're going to conduct a full structural analysis the Iron Financial way. We're going to examine this company from the foundation all the way up. First, we're going to build the fortress. We will lay out the entire bull case and see just how strong its walls really are. Then, we'll take out our instruments and we'll start probing for the fault line in its foundation by taking a deep dive into that massive profit collapse. From there, we'll pinpoint ground zero, the beef catastrophe that's causing all these tremors. After that, we are going to examine the stability of the dividend. Is it a pillar of strength, a sign of confidence, or is it just a prayer to keep investors from fleeing? And finally, we will deliver our verdict and determine the true structural risk of this investment. All right, let's start by building that fortress. Section 1. You see, before we can find the weakness in any company, we have to understand its strength. The bull case for Tyson isn't built on sand, let's be clear about that. It's built on a foundation of massive top-line revenue and some really clear market share gains in its core segments. There's some real muscle here, so let's take a look. The top-line numbers, they really don't lie. Sales are up a solid 5.1% year-over-year. In the first quarter, they pulled in $14.3 billion. That's up from $13.6 billion the year before. Now, you have to put that in context. In this economic environment, with consumers really feeling the pinch from inflation, that kind of top-line growth gets a lot of attention on Wall Street. And frankly, it deserves it. It shows that despite all the economic headwinds, the demand for their products isn't just stable, it's actually growing. So, the next logical question is, where is this growth actually coming from? Is it broad-based across the whole company, or is one division just getting lucky and carrying all the weight? Well, this is where we see the real strength of their diversified model. The chicken and the prepared food segments are doing all the heavy lifting. I mean, look at prepared foods. We're talking about powerhouse brands like Jimmy Dean Sausage and Hillshire Farm deli meats. That segment is up a massive 8.1%, and chicken is also up a very solid 3.6%. These are the strong pillars that are holding up the entire structure right now. That is genuinely impressive performance. And this right here is an absolutely crucial point. They're not just growing their sales in a vacuum. They are actively taking market share away from their rivals. Now, how can we be so sure? Well, it's because while the overall food and beverage category in the United States actually declined by 1.8%, Tyson's retail branded product volume, the stuff you and I buy in the grocery store, grew by 2.1%. You see what that means? It means that when shoppers are being forced to make tough choices in a shrinking market, they are increasingly choosing Tyson products over the competition. That is the sign of a powerful brand and some seriously strong execution. This is the core of the bull case. This is the foundation of the fortress. All right, so the fortress looks pretty good from a distance, doesn't it? The walls are high, the revenue banner is flying proudly, but here at Iron Financial, we live by a very simple rule. Sales are vanity, profit is sanity. It doesn't matter how much you sell if you can't make any money doing it. So now it's time to take out the magnifying glass. Let's start looking for the cracks in that beautiful foundation. Let's see if they are actually making any money at all. And here it is, the first major fault line, and believe me, it is a big one. Their GAAP net income, that's the official by-the-book profit, has fallen off a cliff. It has absolutely plummeted from $359 million just a year ago to a mere $85 million this quarter. That is a 76% drop. So all that impressive sales growth we just got done talking about, it's completely disconnected from the bottom line. The profits are evaporating. This is a five-alarm fire burning in the engine room of the company. Now hold on. The company will tell you, whoa, don't look at that ugly GAAP number. That's not the real story. Look at our adjusted numbers. They're a much better reflection of their real business. But this is where you have to be extremely careful as an investor. You see, the word adjusted is often just another way of saying, we took out all the bad stuff that we don't want you to look at. Which means the most critical question for us becomes, what exactly are they adjusting out? What reality are they trying to hide from you? Let's look at the numbers side by side. The GAAP earnings per share, the official number, is a disastrous 24 cents, down that same 76%. But after their special adjustments for big-ticket items like company-wide restructuring charges and legal accruals, they report 97 cents per share. Now, a 15% drop looks a heck of a lot better than a 76% collapse, doesn't it? But those charges are real costs. That is real cash leaving the company's bank accounts. So let's be perfectly clear. The structural damage is still there. They've just put a fresh coat of paint over the cracks. You can't just adjust away real cash losses. That official GAAP number is what truly matters for the long-term health of this company. So where is the epicenter of this financial earthquake? A 76% profit collapse doesn't just come from nowhere. There has to be one specific segment that's just hemorrhaging cash and causing this much damage to the entire corporate structure. Well, there is. Let's move to ground zero, the beef segment. And let me be clear, this isn't just a problem, it's an outright catastrophe. Now, this isn't entirely Tyson's fault, which ironically makes the problem even harder for them to solve. The external pressure on them is immense. In fact, the entire industry is facing this headwind. The U.S. cattle supply is at its lowest point in decades. It's a simple supply and demand problem, really. Fewer cattle means the price of those cattle, which is Tyson's primary input cost for this massive segment, has absolutely skyrocketed. As a result, their profit margins are being absolutely crushed. They're being squeezed from all sides on this. To really understand the scale of this damage, just look at this number. This is the damage report for a single quarter. In Q1, the beef segment posted an operating loss of $319 million. I want you to just let that sink in for a moment. Nearly $350 million lost in one segment in just 3 months. This isn't just a small crack in the foundation, this is a gaping hole. All those impressive profits from the chicken and prepared foods segments we were so impressed with earlier, they're basically just being shoveled into this hole to try and fill it up. And for anyone out there who's hoping this is just a one-off problem, a bad quarter they can bounce back from, I have bad news. It's not. This problem isn't going away anytime soon. In fact, look at the company's own guidance. They are projecting a full-year adjusted operating loss of up to $500 million in the beef segment alone. They are telling you themselves that this bleeding is going to continue. So the question for any serious investor has to be, how can you possibly sustain a $500 million loss in one of your largest segments and still have your stock hitting a 52-week high? It just doesn't add up. That's the key question. And if the financials are really this bad, why is the market rewarding them? Well, it's likely a mix of things. You've got some investors just chasing that dividend yield, some are betting on a miraculous turnaround in the cattle market, and others are simply rotating into consumer staple stocks as a defensive play in a volatile economy. But a good defense requires a solid foundation. And things get even worse when we look at how they're managing their capital in the face of this crisis. So let's analyze the dividend. On the surface, a healthy, growing dividend is a sign of financial stability. But here, it starts to look less like a sign of confidence and a lot more like a prayer to keep investors from running for the hills. This is genuinely absurd.
In the very same quarter that they reported a 76% profit collapse and a massive loss in their beef division, they raised the dividend. They sent a signal to the market that says, hey, everything is fine. We're strong enough to give our shareholders a raise. But the financial reality tells a completely different story. Their dividend payout ratio, based on those official GAAP earnings, is over 153%. Think about that. They are paying out more than 1.5 times what they actually make in dividends. This is fundamentally and completely unsustainable. You cannot pay out more than you earn forever. It's a sign of profound weakness, not strength.
And if you ever want to know what a company's management really thinks about the future of their business, don't listen to their words on an earnings call. Watch their actions. Watch where they put their own money. While the company was putting out press releases announcing that dividend increase, the chairman, John H. Tyson himself, was busy selling over 100,000 shares of his own stock. The CFO was selling too. The people with the most information, the ones who know the true structural integrity of the business from the inside out, they are heading for the exits. That is a siren-level warning for any investor.
Okay, let's step back and look at the whole picture now. We've seen the strong fortress walls. The chicken and prepared food segments are solid, they're profitable, and they're taking market share. That's the good news. But we've also seen the massive fault line running right through the company's foundation in the form of the beef segment. And we've also seen the questionable financial engineering with that dividend. So now it's time to bring it all together and deliver the final verdict. Is this an opportunity or is it a trap? First, let's see what Wall Street thinks. Are we the only ones with these concerns? The analyst consensus is a resounding hold. Out of 15 analysts that cover this stock, 13 of them are sitting on the fence. Only 2 are willing to put their reputations on the line and issue an actual buy rating. Now, let me tell you, that is not a vote of confidence. A hold rating, especially when you have this many analysts saying it, is often just a polite way of saying, we see the problems, and we don't want to be the ones telling you to buy this thing right before it potentially rolls over. Wall Street is clearly nervous.
And here's the part that should really get every single investor's attention. The average price target from those 13 analysts with hold ratings is $60.60. The stock, as we've established, is currently trading well above that, around $65. So even the most cautious analysts on Wall Street, the ones who won't go so far as to issue a sell rating, even they believe the stock is overvalued at its current price. That is a major flashing red flag. It tells you that the current market price has run far, far ahead of the fundamental reality of the business.
So our verdict is this. Our structural analysis here at Iron Financial concludes that Tyson Foods is a classic bull trap. The fortress has a fatal structural flaw. The strong performance in the chicken and prepared food segments is admirable. It truly is. But it is simply not enough to offset the catastrophic $500 million damage that's coming from the beef segment. And when you add to that an irresponsible and completely unsustainable dividend policy, not to mention the insider selling, the verdict is clear. The structural risk here is simply too high. The risk of a major correction back towards or even below that consensus analyst price target is significant. So the question for every investor who's looking at this stock is very clear. Are you betting on those fortress walls in chicken and prepared foods to hold up against all odds? Or are you preparing for the earthquake that, according to the company's own financials, has already started? The fault line is active and the tremors are getting stronger. For us at Iron Financial, the conclusion is simple. The foundation is simply too weak to build on.